Today, we are diving into the really curious case of Albemarle. Now, these guys are an absolute giant in the world of lithium, that critical metal that's basically powering our entire electric future. But here's the puzzle. For a while now, lithium prices have been, well, tanking. And yet, Albemarle isn't just surviving, they're actually thriving. How in the world is that possible? Let's find out. And yeah, that really is the big question, isn't it? How do you manage to make more money when the price of the thing you sell is going down? It pretty much flies in the face of everything you learn in basic economics. But somehow, Albemarle pulled it off. So let's dig into exactly how they did it. All right, first up, we're going to take a look at the numbers, their financial scorecard. This is where the surprise really starts to become clear, because it shows just how strong their results were in what was, frankly, a pretty weak market. So here it is, the core contradiction in a nutshell. On one side, you have lithium market prices taking a nosedive. And on the other, you have Albemarle's profits, measured by this thing called adjusted EBITDA, actually going up. More profit from less money per sale. I mean, on this surface, that just doesn't seem to make any sense. So let's break down what this adjusted EBITDA thing even is. Okay, so don't let the name scare you. Adjusted EBITDA is basically just a clean way to measure how profitable a company's main day-to-day business is before you factor in stuff like taxes or interest payments. Think of it as a pure look at their operational horsepower. And that operational horsepower, it was up 7% year over year. Just let that sink in for a second. The cost-cutting and efficiency gains they made internally were so effective that they completely wiped out the negative hit from falling lithium prices, and then some. It is a textbook example of focusing on what you can actually control. And listen, these weren't just numbers on a spreadsheet. These weren't just paper profits. The actual cash the company generated from its operations skyrocketed by 57%. And that came from those higher profits, plus a really intense focus on managing their cash. In other words, they weren't just making money, they were making sure that money was actually staying in the bank. So that brings us to the how. How exactly did they pull this off? Well, this next part is all about their leaner and meaner strategy, the specific moves they made inside the company to completely reshape their finances. Their strategy was basically a three-pronged attack on their own operations. First, they went after costs, and they were aggressive about it. Second, they slammed the brakes on spending for new projects. And third, they started selling off parts of the business that weren't absolutely essential to their main mission. And boy, did it work. On the cost-cutting side, their goal was to save somewhere between $300 and $400 million for the year. Well, they ended up on track to save $450 million, completely blowing past their own targets. Next up was spending. They took a hard look at all their new projects and cut their capital expenditures by a whopping 65%. From now on, only the projects that promised the highest returns were going to get a green light. Everything else, put on ice. And that third step, well, it was a big one. They decided to sell a majority stake in their Cajun business, which makes catalyst for oil refining. This one move is expected to bring in about $660 million in cash. That gives them a huge boost in financial flexibility and lets them focus even more on their core business, lithium. You add all three of those moves together and the effect is massive. The company now expects to bring in $300 to $400 million in positive cash flow this year. In a market this tough, going from potentially losing money to generating a big surplus like that, it's just a phenomenal turnaround. Okay, so we've seen Albemarle's impressive internal game plan. But what was going on outside the company's walls? I mean, the reason prices were down was because of a temporary flood of supply hitting the market. But the story on the demand side, that's a completely different animal. And this is where things get really interesting. Even with prices falling, the world was actually using more lithium than ever. Demand was up over 30% just this year. The world is hungry for lithium, and it seems to be getting hungrier every single day. Of course, a huge driver of that demand is electric vehicles. EV sales are still climbing all over the world. You've got China and Europe both growing around 30%, with North America coming in strong as well. But the real explosion in demand, the place where things are just going nuts, is grid storage. We're talking about these massive battery farms that help keep our power grids from failing. And the growth here is just staggering, up 105% globally and an absolutely unbelievable 150% in North America alone. So what's fueling this fire? Well, a huge part of it is the rise of data centers and artificial intelligence. The amount of power it takes to run all of our cloud computing and our AI models is just immense, and it's projected to more than double by the year 2030. That creates this massive need for grid stability, which these big lithium-based batteries are perfectly designed to provide. All right, so we've covered Albemarle's internal strategy, and we've covered the booming external market. For our final section, let's kind of tie those two threads together and see what this all could mean for the future. This quote from the CEO, Kent Masters, really gets to the heart of their whole strategy. See, this isn't just about surviving a downturn. What they're doing is building a fundamentally more efficient company from the ground up, one that's going to be even more profitable once lithium prices eventually start to recover. And here's a little peek at what that new, super efficient culture could mean for their bottom line. Right now, with lithium prices at their current low of around $9, they're still making a very respectable 20% profit margin. But if prices were to rebound to just $15, their profit margin could jump to 30% or maybe even higher. They are coiled like a spring, just waiting for the market to turn. Which really leaves us with one final big question. We all know the transition to an electric economy is happening, but it's not going to be a smooth, straight line. There are going to be bumps and volatility along the way. So in this new world, will success belong not just to the companies with the best resources, but maybe to the ones with the most disciplined, thoughtful strategy? Well, if Albemarle's performance is any indication, the answer might just be a resounding yes.